give us just a real quick background on your experience in logistics, what you did beforehand and how you became a VC?
So probably the only relevant job I held related to logistics was in high school. I worked for an education business in my hometown, and I used to bind, pack, and ship the books out for them, kind of internationally. And we kind of had a small print shop and warehousing fulfillment room, stock room really is what it was. But kind of entrepreneurially, started my first business when I was about 13 years old. And back then, it was around IT support. And I realized there was a growing need for small businesses to have IT support that was affordable, responsive. And so I did that for a lot of the small businesses and entrepreneurs in my hometown in Maryland. And ended up doing that till I went to college and just wound that down because all my friends that I employed had also gone off to college or were about to. And in college again, I got hit by the bug during the financial crisis and I started a media company around the financial markets. And so those are kind of my two, I guess, journeys into entrepreneurship. And somewhere, I don't talk about this really ever, I got misguided and ended up in a big investment bank. And truth be told, who's to say I would be here in front of you and having founded Dynamo if it were not for that. But that's where about 5 years in, I woke up and had this realization, what are you doing? Like, you don't feel fulfilled. Yeah, you might be taking home an interesting paycheck, but what is it that you really want? And everything that I always went back to is entrepreneurship. And part of my last role was to also engage with private companies and VC backers. And that's where I really kind of clicked as to, I want to do that. I want to partner with just bold, visionary people who are smarter than me, who are more capable than me, and be just a good partner and bring what I'm good at to them. And so serendipitously was introduced to my partner, Ted, who in Chattanooga had coincidentally built and sold his freight brokerage called Access America. And on the back of that, he'd been angel investing. And Ted, as Ted does, invited me down to hang out in Chattanooga. Little did I know that it was a long game for him to relocate me, right? And about a week in Chattanooga, I was like, I could spend a year here, right? And at that point, I thought I was going to start a business. And I think probably the things in my notebook that were kind of more towards the top were actually around insurance than supply chain. But this is 2015. Late 2015, I was introduced to my partner, John, who's running somewhere around here from the UK. And John takes credit for defining Dynamo. And when he kind of defined there might be something here, everybody looked at me and said, well, you're kind of the one that really wants to be a VC. What do you think? And I got up and I spoke to probably over 2-3 months, every trucking, warehouse, logistics, supply chain person I could get in front of, just to validate, how do you do work? Why do you do work that way? What's a pain? What's not a pain to you? And I remember coming back into the office about a month into that, and they asked me, what do you think? And I just looked at them, I go, oh, there's a lot to be had here, but if we want to be successful as investors, we want it. It's not gonna be easy, it's gonna be hard, but if we're willing to go on the journey, let's do it. I'm willing to strap in, let's do it.
So that was 2015, 2016?
Late 2015, 2016, we kicked off, we raised our first fund, and that fund now seeded the likes of Stored, Sender out of Berlin, Gatic, who's building autonomous vehicles, Raft, who's here as well at Manifest. So it has a lot of kind of industry, players. That's right. Yeah, it's 6.5, 7 years in. Wow.
It's also Steam Logistics, yeah?
Steam Logistics is also in that fund. Yeah.
Seems almost like 1,000 employees.
Mm-hmm. Yeah, they probably have had the strongest growth in terms of employee headcount in our portfolio.
I'm just curious, why would you invest in Steam as a freight brokerage? Typically, VCs don't invest in freight brokerages, so I'm just wondering if you could give us a little background on that.
So Steam came in a rather non-traditional way into our portfolio as to when we raised our first fund, my partners Ted and Barry actually put a piece of their investment into the fund, so we were all aligned. And we thought it was really interesting because what we basically got was a very infant international business. And with that, we could start testing different technologies that made sense. And by virtue of that, Steam probably doesn't look like your traditional freight forwarding. We use technology, everything's automated away. More so what Steam has realized is that we rely on service. That's why people come to us. And if we can use technology to deliver better service, we win. And furthermore, if we can actually align the three parts of the supply chain, international drayage and domestic brokerage together, that's a really unique value prop that very few people can truly deliver at scale. And that's how they've actually become venture scale. So that's interesting because there are many different ways one can build a venture scale business. And Steam is one of those non-obvious paths.
How much time do you have to get involved with each individual company?
Time is like the one thing a VC cannot scale. Nobody can. Like we can't just snap our fingers and make more time, which is actually the bottleneck in the industry. It's not money. You've seen firms over the last few years scale from like tens of millions to billions, right? But what actually is limited is the partner's capacity. And as a partner, we bear the burden and the responsibility for working with the founders. One, like picking good investments. You want me to pause there for a few seconds? We bear the burden for finding and selecting good investments, but also we call it stewardship. And so our model is generally the first 12 weeks after we make an investment, we spend 30 minutes every week with the business. And that's to basically level on what are the goals we're marching towards, what are the risks, have we understood that properly? Are there other risks that the founder then articulates we need to account for? And then just building trust. Really, the first month is building trust. How do you work together? How do I work together? What does it mean when you show up on an off day versus when I do? Gaining an appreciation for our working style, and then kind of aligning and starting to build momentum to go on that journey. And we think about venture cycles in 18 to 24 months. So because we have that time box, it requires us to focus on what are those key things that unlock that next stage of growth capital. Equally, does it make sense to raise growth capital? That's usually like a Series A to Series B conversation we need to have. And for some businesses, they don't need to. They have margins, they have escape velocity, and it might not actually benefit growth per se. But by and large, say 99% of our investments, you go on to raise. You consume capital to take market share, grow, build margin. So at least 30 minutes a week. Sometimes that's more. That could be an hour. And that doesn't include kind of time we might spend reviewing sales decks, helping them build models, board decks, things like that.
Is being a VC investor glamorous? From my point of view, it looks like a really cool job. What's your point of view?
I have a lot of fun, right? I get to spend my life meeting with really interesting people. They're kind of pushing and pulling on the status quo and the knowns in the industry. And it's really kind of those situations that end up catching fire and building the next big thing. But equally though, I mean, it's a lot of hard work. I'm not gonna say we don't take credit for the success, right? Like our founders do the hard work. But what does that mean for us, right? Like in any given year, we engage as a broad team, 1,000 odd companies. We invest to 4 to 6 of them. We need to do reporting. We have to worry about fund management. That's not necessarily fun, but we are entrusted to do that and do that really well. That's probably the not glamorous stuff, but equally can take a meaningful part of a partner's bandwidth depending on the time of year it is.
It's kind of part of the other question, but what part do you hate?
Yeah, delivering bad news is probably what every VC hates. Like when you have to say no, we sadly say no more than we say yes.
You said that around 1,000 companies reach out to you.
We'll probably engage on an average year 1,000 companies.
And you invest in 4 to 6?
4 to 6.
Wow, okay.
So people can do the math. And and a lot of those no's can go off to be like interesting businesses, but we have to stay confident in our process, our perspective, our read on an opportunity. And if it does end up being the wrong read, being able to have the humility to go back, revisit how we made that decision and ask, why did we not get it right? What did we not see? And being open-minded where if you need to kind of make tweaks or think about something differently. So we have a saying, you have strong opinions loosely held. But also in the situations where we actually were right and this is a blip, being able to kind of lean into that a little more, even though the data and the facts may not quite justify it just yet. Right? And we've had a few of those. And
Can you share which companies?
no, I won't do that, but I mean, there've been a lot of themes, trends, people that we ended up passing on, and in the short term it felt like, what did you guys do? You're idiots, you don't know what you're doing. And as kind of things have unfolded over the last 9 to 12 months, it's maybe you're onto something over there, guys.
So recently some companies were said to have spent their funds on private jets, sponsoring golf tournaments, etc. Has that ever happened to you, squandering money? If so, how?
No, not to my knowledge. Not to my knowledge. So generally when we lead an investment, we take a board seat. And the interesting thing about being one of the first, if not the first investor in a business, is that you have a unique bond and a trust with the founding team that no other investor that comes tends to have. So even today, like we have businesses that are grown up, right? Like are well on their way to growth, 100 million plus. I know nothing about running or building businesses of that scale. I'm not your guy. No one at Dynamo really is. But they still will call one of us when they need personal advice, business advice, or hey, things aren't going right. You're the first person I'm calling because I need you to react. And how do I communicate, right? And work through it. And because of that, we tend to have that close relationship. So we're not watching, but if there was anything as to, hey, are we spending too much, or are we allocating our funds appropriately? We generally know and are able to constructively push back.
You've obviously heard about the Slink.io situation a year ago. What were your thoughts on that?
It's unfortunate, and things like that happen, whether it's our sector, whether it's other sectors, right? In crypto, we've seen this maybe most blatantly in the startup world. I think what we can focus on is what has happened as a result of that and the leadership that's in place now. John Urban's awesome. He's built businesses. He's been, I think, kind enough to come out of retirement to ensure that the right pieces are put back together and they're back on a constructive path. So time will tell. It's in all of our best interest that companies succeed. So even if there is poor judgment, decision making, the fact that they can come out of that, I mean, hopefully we're all rooting for it.
How do you value a startup in the seed stage in terms of knowing what equity each invested dollar should be worth?
I have a friend who once told me he thought venture math was gypsy math. And at times, I mean, that may not be a far-fetched statement, but generally pre-seed, seed, Series A valuations are driven on ownership and really amount raised. And so generally the giveaway, if you think about ownership, for me, that word is ownership. For a founder, it's dilution. They're the same thing, but point of reference, you call it something different. At pre-seed, kind of, you generally will be giving away, call it 15 to 25% of your business. If it's deep tech, it's probably more 25%. At seed, it's 20 to 25% as a founder. And again, it's a Series A, you're probably giving up 20 to 25% of the business. And so kind of based on that, as seed investors, kind of we're looking at a world where seed rounds are 3 to 4 million. So you're looking at valuations, call it anywhere from 12 to 15 million, 16 million, 20 million, depending on dilution at that 4 million range. And really what you are doing is you're making an assessment as to, based on what you've done so far, We think if we give you $3 to $4 million in 18 months and 24 months when you need to raise again, you will have enough milestones to go raise that next round of capital. And that next round of capital might be anywhere from, call it, $8 to $12 million. If you're really growing and really successful from seed to A, you might be able to clock in a 20 million raise. And again, at around those dilution values. So if you do the math on that, a 10 million round Series A, which we think in this normalized venture environment that we're operating in, you could be looking at valuations of 40 to $50 million. That's where the world used to be before COVID. So it's not like nobody needs to freak out. We're just coming back to some norms. And that's, I think, healthy.
So you mentioned that in the beginning, you take around 25% of the company in a seed round, and that goes for 3 to 4 million?
From all the seed investors. Yeah, so as Dynamo, if we lead, we'll probably take anywhere from half to 3/4 of the round. Okay. So what that means for us is we want anywhere from, call it, 12 to 15% ownership. And we can take down, call it, 1.5, 2 million of the round, at which point we believe that it takes a village, especially at seed, to help a founding team. So we'll sit you down and we'll say, who else should we have in the round? I don't want names and firms, that's not constructive. What competencies do you believe you need to de-risk the business and to help you grow? So a lot of things that we'll hear is, hey, could we get somebody that has SaaS experience? Could we get somebody that has meaningfully built hardware products or hardware-oriented SaaS businesses? If it's like autonomy, electrification, hydrogen, could we bring subject matter experts there? So we equally are open to, hey, like bringing these types of participants in thoughtfully, because the pie is going to grow if they're involved, right? And ultimately, if we grow the pie, even if I have a smaller piece of the pie at the end, I should still be better off. Yeah. And that's what venture is really all about.
How has the investing changed in the last year? Was it the same number where it was 3 to 4 million a seed round, valued at around 25%? How did that look like a year ago?
No. So you had actually both round sizes increase and giveaways, dilution go down. And why that is there's a few different kind of theorized reasons. I think the most reasonable one is there was a lot of actual seed funds and then also Series A funds that are coming down to seed, chasing opportunities, just wanting to deploy. So discipline was lost amongst venture investors. So as much as venture investors in the last couple of years whined about valuations are high, I'm not getting my ownership, like that means my fund model doesn't work, my LPs are on my case, is to kind of look and question yourself, but were you kind of perpetuating this by not being disciplined? And sometimes it will be uncomfortable, but there's always a line that you're not willing to go beyond, no matter what the investment is. And you should always have exceptions within a fund, and those exceptions generally are, I'm willing to take less ownership. It's probably because the market is really large, and sometimes you have a really large market and an amazing founder that together give you that comfort as to, I can still return my fund. That's the math that we underwrite on, a lot of seed funds underwrite on. And basically what you're doing is, relative to my ownership and my fund size, what is the exit value this company needs to sell at, go public at, for me to return my fund? Because that's when I've made my LPs whole. So if they've given me a $10 million fund, when I return $10 million, I start to take my profit share, right? Carried interest. So at Dynamo, that's about $500 million. And for some people, it's like, are you not swinging for the fences? It's like, actually, no, I'm probably swinging for the fences more than even some of the other guys. It's just more meaningful when we hit one of those billion-dollar outcomes. It's multiples for our LPs. And equally, that also means we could be pragmatic, because $500 million acquisitions they're still actually an outlier event. And we got to work hard for them. Most businesses exit for $150 to $200 million. So people who kind of poke at that or try to say, oh, you don't have bold enough ambition, it's like, actually, I don't think that's quite true. I'm just thoughtful about how to make money for people who have taken a bet on Dynamo.
How do you find most of your deals?
Referrals. So out of our most recent fund, we ran the math a couple months ago here, and two investments were actually inbound into us. We have 20 investments in our second fund. Not all of them are announced, but of those 20, two are inbound. I think a couple of them, in addition, were sourced where we outbounded, and the balance for referral. But we run a very aggressive outbound effort. People looking in from like operator world would probably say, as an operator, I actually recognize that as you're running it like a sales team. So we have metrics, our juniors are held to that metrics. Equally, we go out and we try to put parameters around investor relationships. So as much as we can, make it data driven, but the tailwind is like we're out there, right? Have a podcast, have a newsletter, showing up to events, having opinions, but again, keep them loosely held. We should change our mind if there's contradictory information consistently. And just trying to be a good shepherd of the ecosystem. Right? We stand on the shoulders of giants.
Do you prefer US deals or do you invest globally?
I send from Berlin. Have a partner, John's based in the UK. About a third of our investments are abroad. So frankly, we're more focused on what is the problem, is the approach that the team is bringing the right approach to solve this problem and build a really large business on the back of that. Sometimes that means, hey, like the small city you founded it in, over time you might need an HQ2, or you might need to move the center of gravity for talent purposes. But through COVID also, there are some founders who are well equipped and thoughtful enough to build a remote business. And we're open to that as well. Not everybody can do it, and you have to go eyes wide open into that and be very self-aware and not kind of lying to yourself that you can do it when you maybe can't, because it's a very different set of motions and operations. But by and large, I don't really care where a company is, as long as it's the right people.
Hunter's out of Brazil.
Yeah, he's down in Brazil. He gets on a plane wherever he needs to, or his team does. Hunter is wandering around somewhere here with Bosco. Yes. So yeah, I think that's a really good example as to, as long as it's the right people, right? And in that case, just willing to get on planes like that.
Where does a VC like Dynamo get their cash to get started?
Yeah, so behind every VC fund is a pool of investors that you call limited partners. And just a fancy legal way, because of the way you would structure a venture fund, for saying investors in a fund. So these generally tend to be like foundations, family offices, high net worth individuals. You also have like endowments, sovereign wealth funds that tend to play in this world as well. So for us, we tend to lean in on foundations, family offices, high net worth individuals, funds of funds. You also see insurance companies, because they have large pools of capital that they need to get yield on, also participate in venture capital. So we cover the gamut.
What are you most excited about in 2023?
I'm really excited, honestly, for the discipline that's coming back into the system. And I think over the last few years, investors, as I mentioned before, are partly to blame for this as well. But in certain instances, lost just basic business discipline, right? How do we think pragmatically about raising what it needs to achieve in order to unlock the next round of growth capital, experimenting around how to attain those achievements, attain those goals. And with that also, I think this year we will see a breed of founder show up that just has the grit and the resolve that they're going to build a lot of big businesses. A lot of big businesses over this year, next year, I think will get seeded, founded and seeded. And that'll be what one might call the second generation of supply chain technology. If you think that Flexport, Sender, Stored were that first generation, Flexi, you're going to see that second generation come.
It's an exciting time.
This is an exciting time. It's an exciting time. It has its challenges for founders who have already raised, who need to make some hard decisions as to where they allocate capital. Am I even able to hire? I might actually have to let go of people, which we've seen in our sector the last few weeks. But by and large, when you take that medicine and you set yourself up thoughtfully for the next couple of years of the journey, you'll be okay. It hurts in the short term. There's a lot of emotions in the short term, but it's for the better.
Any companies on your radar that you want to talk about that you recently invested in?
So we have a recent investment that's not announced around hydrogen. So when that comes, there'll be more to say, but kind of the cliff notes is over the last couple of years, we've had just this fierce debate internally, electric or hydrogen. And that's the wrong debate to have. It's where's electric relevant, where's hydrogen relevant? And we have a big investment around batteries, and we think batteries are the answer for last mile, and then by that, kind of consumer mobility applications. But when it comes to distance, payload, tonnage, it's really hard to ignore hydrogen. And a lot of critics say, oh, we've seen this happen before, but the interesting thing that we got the tailwind of after we did this kind of all hands, let's go really define how we feel as Dynamo is the IRA. And the IRA has brought the fundamental economics of hydrogen forward from, call it 2030 is what most people identified it being as like viable for business, to this year, next year. So really excited to kind of see where that goes. That's a deep tech kind of twist to that as well. But prior to that, we funded a business out of Berlin called Ruvia that is allowing forwarders to book intermodal. So they're able to source capacity, rate, as well as book all digitally. And that intermodal shift could actually save people on their freight bill by about 30% and can cut your carbon footprint as you look at your scope 3 emissions by 90%. And European focus, there's more of a consciousness as well as regulation that's getting ready to bear down. So yeah, you get it.
In terms of return, what was your biggest win and what was your biggest loss? Is today's environment still good to raise money for startups, or should they wait?
Yeah. Biggest win, biggest loss. We've had a few businesses not work out, right? I think if anything, if you were to ask my LPs, it's the loss ratios for whatever reason at Dynamo are much better than perhaps any other fund that we invest in who might be a generalist investor or a SaaS investor. And part of the challenge of venture is our feedback loops are a decade or more. So I can't tell you why that is. Maybe it's because we're better pickers, and because we only live and breathe the industry, we can quickly ascertain something that is a thing versus not. We're known for the good work of a lot of our teams, right? Like Stored down in Atlanta. Sean will be here, I think later today, tomorrow. David and the guys out at Sender in Berlin. You mentioned Jason Steve at Steam. Gautam and the folks at Gaddick. So there's a lot of folks kind of that we've had the good opportunity, good fortune of being on the journey with, but all credit to them for that. But with that, I think your follow-up was like, is this a good time to raise? Yeah, I think it's a great time to start a business. It's always a great time to start a business in an environment that is identified as being adverse or difficult. Because if you can get through those environments, by and large, you'll succeed when things go well. You can't really do the opposite as easily, right? So kind of iron sharpens iron mentality. So yeah, it's a great time to start a business. There are a lot of, I think, pragmatic, good people that are willing to go on that journey in the early days, pre-seed, seed, us included. So give us a shout. And even if it's not for us, we hope to kind of give you feedback, make an introduction where it might be helpful for you, and cheer you on.
How can they reach out?
I'm Santosh at Dynamo.vc. If you're not able to figure out how to spell that, hello at Dynamo.vc. On our website, there's a big button on the homepage, just hit it, and that comes right into our inbox.
Thank you so so much.
Thanks, man. Yeah, good to see you.
Yeah, for sure.